Look at this May 2026 document. The Fed officially blinked, tearing open the gap between policy and market reality. This chart shows the math. Markets price a 58% probability that inflation stays above 3%, while official narratives claim 35%, a 23-point spread. This divergence is reinforced by the simple act of looking at it. By focusing your attention entirely on this gap, you become a participant in the tension the system creates. The question is whether you will continue to look at these events through that same lens. The tension centers on incoming Chair Kevin Warsh. He is positioned at the witness table under massive political pressure to lower interest rates, even though the underlying economic data makes those cuts nearly impossible without triggering a new wave of inflation. When the institutional story moves one way and capital moves another, the signals that once guided the market effectively go blank. In that divergence, you are left to navigate the resulting vacuum on your own. This infographic highlights the first force driving the fracture: energy. Notice the section on supply shocks. With the Strait of Hormuz effectively closed, Brent crude is trading at over $100 a barrel, regardless of what the Fed says about price stability. This is a problem of supply geometry. The central bank cannot print a new shipping lane, and it cannot cut interest rates to make oil tankers move. The physical world is simply grinding to a halt. You have no power to unblock a global maritime strait. The only thing you can actually unblock is your own internal reaction to the news that it has happened. The second force is political. This chart shows the 54-45 vote breakdown for Warsh's confirmation, the result of a single senator leveraging a criminal probe into the outgoing chair to force a change in leadership. Because of this sequence, the Fed's institutional independence has shifted. It is no longer a fixed boundary. It has become a fully tradable political variable. Inside the building, the fracture is structural. Jerome Powell has taken the unprecedented step of staying on the board after his term as chair, but is remaining completely, structurally silent. That silence is met by an open rebellion from the regional branches. Presidents like Beth Hammack, pictured here, are now officially dissenting on the record against the new chair's bias toward easing policy. The macroeconomic system is finding its silence. You, however, have yet to find yours. The programming of the macroeconomic machine has shifted. Its primary function is now the minimization of government financing risk, a priority that is being pursued even as it places immense pressure on the labor market. Households are absorbing the impact of this new function. The median consumer is surviving through consumption deferral, maxing out credit cards while waiting for rate relief that capital markets suggests is not coming. The official narrative of a strong economy works for those who hold assets in the upper deciles. For everyone else, the median experience has become the acceptable casualty of the machine's new objective. This calendar identifies the next major collision. On June 17, 2026, the Federal Open Market Committee will meet just days after a high-stakes inflation report is released to the public. Will the new chair force a rate cut despite the data? Will the regional dissenters hold their ground and block the move? I am not going to offer a macroeconomic prediction. The gap between the official story and the economic reality will resolve itself, and it will do so entirely without your input. You do not have a vote at that meeting. You cannot change the inflation print, and you cannot alter the path of the committee. Your only remaining agency is your attention. Withdraw it from the macroeconomic terror you cannot steer. Stop looking at the gap and give your full focus to the absolute present moment, right here, before you stand up.